Time frame correlation. What is time frame correlation? Time frame correlation refers to the understanding of multiple time frames at the same time. Why is time frame correlation important? Understanding time frame correlation is important because you need to know where you are in relation to each time frame. As you have already learned with complex structure, there is structure within structure. There will be complex structure within complex structure. Time frame correlation does not solely apply to structure. It will apply to all of the other concepts as you progress through the course. Understanding where price is and its role / objective for each time frame will be crucial to becoming a successful trader. So I'm gonna put it this way, because in my head these examples make sense, but obviously you guys aren't me, so I'm gonna try it a different way, see if it makes sense. So if I show you this, what do you guys think structure is?
An uptrend
Okay, why?
Bullish.
Okay, why do you guys say that?
because there's higher highs and lower lows.
Okay, so I'm assuming you guys are referring to these points, all right?
Yeah, I mean higher highs and a higher lows.
Correct. So you guys are right there. What if somebody came and told you guys this was a break of structure and price is in a downtrend? Price was up and then price went down. They said, look, there's higher highs and higher lows. Price made a lower low. That is a break of structure. And now price is in a downtrend. How would you guys respond to that?
I would ask them why.
They said because price is making higher highs and higher lows, and then price has a break of structure by making a new lower low, which is here. So by definition, that is a break of structure, bearish break of structure, and price is in bearish structure now. Isn't that what a break of structure is?
I thought that was
Yeah.
each character.
Got you. Okay. So Andres is saying it's a change of character. That's not a bad idea. Nas, what are you thinking?
Wouldn't that still be an uptrend
Where?
since it didn't break past the low?
Got you. You're still referring to this one, right? I'm assuming.
Yeah.
I got you. And this is your range.
Yeah.
Cool. I see that. Nas, you got any input?
I would still say it's bullish, but I would still say it's bullish because it never broke.
Got you. It never broke this range.
Right.
Okay.
But at the same time, I'm looking at the next structure there, and it looks like it did break.
Or here.
The fifth red circle,
1, 2, 3, 4, 5 here.
it did break. It created its own new structure there.
Yeah, I'll do this. This is, you understand this is range 1, right?
That's what they call range 1, and then range 2. Would that be the next one?
Yeah, so this will be the second range. I'll change the color actually. That's the second range.
Okay.
And this will be the third range.
I would still say it's bullish though.
Okay.
I just feel like it. I will still say it's in an uptrend, but it did break a few structures. But I would think it's an overall uptrend in those structures there. I don't think it. I don't see where it was bullish at. Unless I'm seeing something wrong.
Well, you don't see where it's bearish, right?
Bearish. I'm sorry.
No, you're good.
Bearish.
I got you. Okay. So what I'm trying to point out is this: if price is in bullish structure, we understand that this is the continuation leg, right? The continuation move, not the retracement.
Yeah.
We understand that this part would be the retracement because it's going bearish within bullish structure. So going back to the continuation, if this is the 1 hour time frame, it's just a separator. If I zoom in into this continuation continuation leg of structure, and let's say I go down to the M5, which is the 5-minute, do you think there will be more candlesticks or less candlesticks? More, right?
More.
Yeah.
Cool. So if there's going to be more, do you think there's going to be more ups and downs or less ups and downs?
More. It's more.
Correct. There's gonna be more. So what I'm trying to show you is when you go down to a lower time frame, you're gonna see something like this. Because the higher time frame can't show you all the little details. It shows you the bigger picture. When you go down to a lower time frame, it shows you the same picture, but more details of that picture. Meaning there will be more candles and there will be more ups and downs. So on that time frame, on the H1 time frame, you are right. Both of you guys are right. This is structure. But when you go down to the M5 time frame, this will be M5 structure. And when you understand M5 structure is bullish, going upwards, you start to understand that M5 went bullish, so price could make a new higher high. So the lower time frame is bullish to help the higher time frame out. The only way the higher time frame can get up here, excuse me, is if the lower time frame is bullish as well. You can't have a downtrend because price is going up here. So when I grab this and move it over, this is what you are seeing on a lower time frame. You are seeing M5 structure. And like I said yesterday, you can have M5 structure within H1 structure, and they could be completely different structures. And Andreas, I believe you said that would be a change of character. And I can see where you think that. I don't think that's a bad thought because it is structure within the higher time frame structure. So therefore, since the structure is within it, you think it's internal. So if it breaks, it's an internal break of structure, which is also a change of character. So I don't think that's a bad way of thinking about it. I think that is pretty much almost the same thing. The difference is if I'm on the H1 time frame and it looks like this versus if I'm on the H1 time frame and it looks like this, you still have a low, you still have a high, you have a higher low, higher high, higher low, higher high. On this time frame, I didn't have to go down to a lower time frame. I didn't have to zoom in. I stayed on the H1 time frame. The only difference is on the H1 time frame, now I have internal structure. Internal. So the internal structure points, especially the fact that it got underneath, given that change of character, that's the difference here. The difference is you're not zooming in to a lower time frame. And like I said before, from a bank perspective, if you zoom in, a change of character is a break of structure on the lower time frame. So they do go hand in hand. But the biggest key difference here is I'm trying to tell you is that there's a difference between price looking like this on the H1 H1 time frame and price looking like this on the H1 time frame. Does that make sense?
Yeah.
Yeah, they just look different on different time frames, right?
Correct. So going back to these pictures, on the left side, I have the higher time frame labeled as the blue line. And you can see on the blue line, you can see it's clearly bullish structure, right? But when you go down to the lower time frame, which is in red, you're going to have bullish structure that gives you the continuation leg. And then when the lower time frame breaks structure to go bearish, it's going bearish to give a retracement for the higher time frame. So this right here, higher time frame, is bullish, right? We got that part. But when we go down to the lower time frame, which is represented by the red, so say the blue is H1 and say the red is M5, 5 minutes. So here you can see there's a low to a high, low to a high, low to a high. And again, the lower time frame, you literally have to go to the lower time frame. You're not going to see this all at the same time. That's the biggest difference here. You have to literally go down there to see it. And then price makes a lower low. This right here would be a break of structure. And then price gives a lower high and a lower low. So that right there was bullish structure going into bearish structure. But the bullish structure that came into play correlated with the higher time frame to help the higher time frame create the continuation leg of structure. And when price went bearish and broke structure and went downwards, you understand that that bearish break of structure was so the higher time frame can go bullish. And the reason why it's important to keep track of the time frames and the structures within structures is because if you don't focus on the higher time frames, now yes, we see price is bullish. Let's pretend and say we don't look at the higher time frame. We're only looking at the lower time frame and we see price broke structure and went bearish. Now you're going to be thinking, okay, price is going to go bearish and keep dropping down lower. Or a better example, I'll move it up because, or I can keep it that way. If this is a low to a high on the higher time frame, it's bullish structure, correct? So should we be anticipating this low to be broken if we're in bullish structure?
No.
Correct. So if you don't look at the higher time frame and you only look at the lower time frame, can you see how you could get confused and start to take sells thinking price is going to break down here? Obviously you don't see that low because you're not looking at it, but can't you see how you could potentially be selling for too long? And what happens here, even in this example, you say, oh, break of structure, high to low, high to low. I want to sell because I think price is going to do this and then do this because we're in a downtrend. So you go ahead and take a sell and then price stops you out. Well, price stopped you out because you were taking a sell on the retracement of the higher time frame structure. Does that make sense?
Yeah.
Yeah.
Okay, so that's what I'm trying to describe in here. I'll read this one more time because I know we went through it yesterday, but for the YouTube video, I'll say it again. So how to spot time frame correlation. Bullish structure on the higher time frame. Let's take a look at bullish structure on a higher time frame. The higher time frame is printing structure higher lows and higher highs. You can see the continuations and retracement legs of structures, but within those legs of structure, on a lower time frame, you can see another set of structures. There will be a mixture of bullish and bearish structures that represent the retracement and continuation legs in relation to the higher time frame. In this example, within the higher time frame's continuation leg, the lower time frame is printing bullish structure. The lower time frame's bullish structure's purpose is to continue to go bullish to give the higher time frame the continuation leg of structure. The lower time frame eventually begins to create bearish structure. The bearish structure's objective is created to give the retracement leg of structure relative to the higher time frame. Although this example only shows 2 time frames, this concept can and will be used with many more time frames all at once. So to reiterate, the bullish structure on the lower time frame is there to create the continuation leg of structure. When price breaks to bearish structure on the lower time frame, you understand that price eventually has to give a retracement, And so when price breaks structure, that is the lower time frame helping the higher time frame out to create that retracement. But it's important for you to understand that it is a retracement because if you just focus on the lower time frame, you're going to think the bearish structure is going to go on not forever, but longer than you probably anticipated, right? So when you do get the bullish breaker structure back to the upside, now you have a better understanding of the higher time frame coming into play and the lower time frame. And what I'm trying to say about that one is if you see the breaker structure here and you take a sell here, you shouldn't anticipate price to go all the way down here because price is in bullish structure. Now, if you see a bullish breaker structure and you take a buy here, now if it correlates with the higher time frame, you understand price made a low to a high, a higher low, and price is making a higher high. You can hold this trade longer because not only is the lower time frame in bullish structure, but you are also anticipating a higher high on the higher time frame structure, right? So it helps you keep track of where you are within price. Because if you just focus on one time frame, you most likely will get lost because all the time frames play a role for each other because it's all part of one big picture. Does that make sense?
How far in time frames do you go back?
There isn't a specific amount. When you first start off, I recommend to maybe keep it down to a few that make sense to you. But honestly, I'll use all the time frames. Even up here, I have all these time frames. I won't actually look at every single one, but I will use them at some point. But typically, I would say I use the 1 minute, sometimes 15 seconds, 1 minute, 5 minute, 10 minute, 15, 30 hour, 4 hour, and daily. But if I need to see something a little bit clearer, I will. But they all can be used, you know. And as we break more stuff down, as we put it all together, you'll start to see it a little bit more. Bearish structure on the higher time frame. Let's take a look at bearish structure on a higher time frame. The higher time frame is printing structure lower highs and structure lower lows. You can see the continuations and retracement legs of structures, but within those legs of structures, on a lower time frame, you can see another set of structures. There will be a mixture of bullish and bearish structures that represent the retracement and continuation legs in relation to the higher time frame. In this example, within the higher time frame's continuation leg, the lower time frame is printing bearish structure. The lower time frame's bearish structure's purpose is to continue to go bearish to give the higher time frame the continuation leg of structure. The lower time frame eventually begins to create bullish structure. The bullish structure's objective is created to give the retracement leg of structure relative to the higher time frame. Although this example only shows 2 time frames, this concept can and will be used with many more time frames all at once. So just flipping it around, the higher time frame is bearish, but when you go down to lower time frame, you start to see this. You're going to see structure within structure. And when price is giving you bearish structure, you understand that the continuation leg is in play in relation to the higher time frame. When the lower time frame gives a bullish break of structure and price goes bullish, you understand that it is a retracement in relation to the higher time frame, and so on and so forth. Does that make sense?
Yeah.
Could you re-explain it just a little bit?
For sure. So let's see if this helps out a bit. The left side in black is the higher time frame. We'll go with the H1 time frame. You see that this is bullish, right?
Yeah.
Yes.
Cool. So if I go down to the lower time frame, let's pretend we don't see the higher time frame. I'm just looking at it from here. What happens is this is a low, the high, low, the high, low, the high, low, the high. Wouldn't you guys agree that this is bullish structure?
Yeah.
Yeah.
Cool. And then price breaks this low. Would that be a bearish break of structure? Cool.
Yeah.
So now you get lower highs, lower low, lower highs, lower lows. Price makes a higher high. Would that be a bullish break of structure?
Yeah.
Cool. So
Yeah.
higher high, higher low, higher high, higher low, and so on and so forth. Break of structure. Lower low, lower high, lower low, lower high, lower low, higher high, break of structure. Higher low, higher high, higher low, higher high, higher low. So now we understand that this is bullish structure into bearish structure, into bullish structure, into bearish structure, into bullish structure. Do you guys see that? So it flips multiple times.
Yeah.
Okay, so if we see that and I drag this across over here, this is what is going on the lower time frame. You can't see it on the higher time frame, but on the lower time frame, on the M5 time frame for this example, M5 will be bullish. And when it's going bullish, it's helping the higher time frame create the continuation leg of structure. And when the lower time frame has a break of structure and goes bearish, what that is doing is helping the higher time frame create the retracement. When it goes back bullish, gives the bullish break of structure, the lower time frame is bullish to help the higher time frame create the continuation leg of structure. And one more time, when price goes bearish on the lower time frame, break of structure right here, what it's doing is helping the higher time frame create retracement leg of structure. And why it's important is because say you are taking sells here, you're on the lower time frame, you said, oh, my structure is bearish, I want to take sells today. That's perfectly fine, take those sells, but understand that you are taking sells, which is a retracement on the higher time frame. Just understanding where you are in price. Because if you don't look at any of this and you get on your charts, and obviously you can't see the future, you don't look at the higher time frame, the right side's the future, the left side, I just block it off because you're just zoned in, you're just honed in on this. What you're gonna see is you're gonna say, oh, there's a low to a high, low to a high, price broke structure, lower low, lower high, lower low. I want to keep selling, but you fail to realize that the higher time frame is in bullish structure and that this sell is only a retracement. And so maybe you see this lower high to lower low. I know it happens quicker here, but you think it's a good opportunity to take a sell here. You do something like this, and then price plays out and it hits your stop loss. Where you're confused because why did price hit my stop loss? Price was in bearish structure. I should be selling, right? Well, you failed to realize what the higher time frame was telling you. Yes, you were selling with the trend. You were selling with bearish structure, but that bearish structure was a retracement within the higher time frame. So best case scenario would actually be to wait for your lower time frame to be in bullish structure since your higher time frame is already in bullish structure. Now you have 2 time frames correlating with each other. So instead of taking a sell, not knowing how far the retracement will go, like I told you guys, you don't know how far the retracement will go. You wait for a bullish break of structure, which it does look very similar to that change of character that I described to. The only difference is you don't see the change of character on one time frame. You have to go down to the lower time frame, pick out the lower time frame's structure points instead of seeing it all on one time frame. So if you wait for your M5 to go bullish and then you decide to take a buy at this higher low, the difference here is if you don't see any of this, if you take a buy at this higher low, where should your take profit be? And obviously you guys see all this stuff here, but
At the high,
let's see. This high?
if you're buying
Yes.
at the first black circle there, then your take profit should be at the second black circle.
Well, you don't see the second black circle yet.
Okay. So then you should take profit at
This is all you see. You see, oh, we were in bearish structure and we're in bullish structure now. I want to take a buy because we're in
Like-
bullish structure.
well,
The last high.
Which high?
is it the black line right there?
You would have to look back.
Got you. So you want to look back here.
Yeah.
And you want to
said
take a
last high.
you want to take profits somewhere up here.
Yeah.
Okay, so let me break it down this way. This is a new chart. Let's not think about the past chart. Are we in bullish structure right now?
Yeah.
Okay, if I take a buy, where
Yep.
should my take profit be?
At the last high.
This one?
Yeah.
Okay. Nas, would you agree?
The second hump there.
Yeah, if you take a buy here, where should your take profit be? Andreas is saying right here.
Well, if you're in a buy.
Yep, I'm buying right now. I just placed a buy order. Stop loss. I'm trying to figure out where my take profit is going to be. And obviously, if I'm in bullish structure, I'm anticipating a higher low to be created and create a higher high.
Well, based off just the way the previous chart been going,
Mm-hmm.
I would put it, let's take profit at where the last high was.
This
Be my
one?
guess as well. Yeah.
Okay, cool. I would too, because I'm anticipating this to be the higher low that leads into a higher high. So we're good there. Price hits or take profit, all good. Now, price, would you guys agree, broke structure here?
Yeah.
Cool. So would I be looking
Mm-hmm.
for buys or sells?
Buy.
Why would I be looking for buys?
A sale if it broke through the structure
With a
there.
bullish trend?
If we have a break of structure, are we still in bullish structure?
No, no. We're in
Okay.
bearish.
Got you. So if we're in bearish structure, if we're in bearish structure, would we be looking for sells or buys?
Sells.
Okay, I agree with you. We're in bearish structure. We should be looking for sells. Yes, you can't take buys. If you want to take a retracement trade, sure. As long as you understand that it is a retracement. But if you think this is still bullish structure and then you take a buy here and then you think, oh, we're going to make new highs, I'm going to take profit up here. What's going to happen is this, and you fail to realize that it was a bearish break of structure. But we agree, it's bearish. We're looking for sells. Price comes on up here. I'm looking for sells. My stop loss is somewhere up here. Where should my take profit be?
If you're selling, you would take it at the last low.
This one?
Yeah.
That'd be my
Okay.
guess.
Yeah, I think it's a good idea. You think this is the higher low? Price is gonna make a lower low. This is a good area to take profits on. I agree. One more time. Price makes that lower low, hit your take profit, and then price comes on up here. Would you guys do the exact same thing? Take sales here, take profit
Yeah.
here. Okay, I agree with the other two. Let's say price does this now. Is this a break of structure?
Yeah.
You're looking for sells or buys.
Mm-hmm.
Buys.
Okay, price comes on down here. You look for the buy. Where would your take profit be?
Not that last high, but the last one.
This one? Or are you talking
Yeah,
about
yeah,
this one or this one? This
yeah.
one?
That's what yeah.
Okay, Nas, would you agree?
Mm-hmm.
Okay, so I agree with you too. Price per structure. This is the last structure high. I take a buy anticipating the higher low, and now I'm anticipating a higher high. Therefore, my stop loss, not my stop loss, my take profit will be there. So at that same logic, price was in bullish structure. It broke bearish. Price went bearish. Now price broke bullish. Why would my stop loss be up at the high over here? I know there's a lot of colors. I believe you guys agreed that price we should take profits up here. Why not take them here? Just like how we did right here. We didn't take profits all the way up at this high. We decided this one. So why when we come here, we're not deciding this high?
I don't know.
Okay, that's a solid answer. Andreas, you got a thought, an idea?
No, I think we should take profit right there.
Okay, so the point I'm trying to bring is obviously I was already showing you the background knowledge of understanding the higher time frame. So you guys had the right idea of wanting to take profits up here. But I was trying to show you guys the point of if you don't consider the higher time frame, you're going to take profits here, which isn't bad. This is still a good trade setup. But what I'm trying to tell you is when you understand the lower time frame correlates with the higher time frame, what happens is instead of just taking profits here, because you're right, this is a break of structure, you should take a buy here and then hit your take profit and call it a day. The difference here is now you understand on the higher time frame, this is a low to a high, higher low, and you are anticipating a higher high. So now your risk to reward, I don't think I really gone over that yet, but your take profit level gets increased because not only do you expect price to go through this high, you're actually anticipating price to go through this high. And if you notice, obviously that's much more pips. You're gonna have a higher probability trade setup. And the reason why it's a higher probability is not only is your lower time frame bullish, your higher time frame is also bullish. You have two time frames correlating together. And not only were you able to lower your stop loss, minimize your stop loss, you're able to extend your take profit. So obviously you're risking less to gain more, while also it being a high probability setup because both time frames are correlating. So I was trying to get to the point of if you just get stuck on the lower time frame, you won't know if you are in a retracement or a continuation. If you don't know you're in a retracement, you'll probably be taking sells, thinking price is going to drop all the way down, but you fail to realize that the retracement will end and the continuation will continue. So you take a loss there. And if you take a buy here, you actually probably would win, but you're going to cut your losses short. Because when you take profits here, not a bad trade. You got profit, all good. But what you could have done is caught this move because you understand the higher time frame was also bullish. You're anticipating price to give a higher high. Does that make sense?
Yeah.
I think so.
Okay, so that's why here, this is why time frame is important. And then to wrap it up, time frame correlation from a bank perspective. Time frame correlation from a bank perspective is simply the fact that the algorithm is working on all time frames. The algorithm is working on all time frames to reach its objectives. And what I mean by that is once again, if you are getting bullish structure into bearish structure into bullish structure, this lower time frame is bullish, bearish, bullish. But the higher time frame is going to be just bullish, as you guys have seen. But the lower time frame, and as we get into understanding more about the algorithm, what it does, what I'm trying to say is if price needs to go here, say price is here, right? If price needs to get down here, the algorithm will work on all time frames. The algorithm knows I need to get down here again. So the lower time frame helps out and kicks in and says, okay, we need to break structure to push it on down. And then once it reaches its objective, only the banks understand where they want to take price. In this case, they want to drive price back on down so they can buy again. The algorithm kicks in again, says, okay, we need to get price up to this new high. How do they do that? They switch their objective. They start to buy. And that's what causes a break of structure. The algorithm was selling. The banks were selling. The algorithm kicked in, switched its objective because now it has to get up here. So that's what creates the break of structure. Gives us a clue that now the banks are buying and then they continue to buy up to the upside. Does that make sense?
Yeah.
Yes.
Okay. So that's all it really is. And then top-down analysis, whenever you're looking to trade a market, market, always perform a top-down analysis. This means you should always read what the higher time frame is telling you before reading what the lower time frames are telling you. The reason for this is because the higher time frame will always take precedence over the lower time frame. The lower time frames are working together to get to the objective of the higher time frame. This is important to keep in mind so you do not hyper focus on one time frame. So what I'm saying here is whenever you are on the chart, you should do a top-down analysis, meaning what is the higher time frame doing, and then going down to the lower time frame and seeing what the lower time frame is doing. Because at the end of the day, the most important time frame is the higher time frame. The higher time frame gives you the bigger picture, and the higher time frame allows you to understand where you are in relation to the lower time frame. Once again, if price is in bullish structure, and then you go down to a lower time frame to read this, you read this area, what you're gonna see is bearish structure. Now, if you just hyper focus on this and not look at the higher time frame, you're gonna say, oh, we're in bearish structure, let's keep selling, right? But what happens is price then stops you out and then does this, and you're confused on why price stopped you out. Well, it's because you were hyper focused on the retracement. This retracement wasn't there to last forever. The retracement was to get price on back on down so the banks can buy and then give you a new higher high, just like that. So if you hyper focus on the lower time frame, you won't see where you are in relation to the higher time frame. That's why you should always do a higher time frame. You should do a top-down analysis, meaning go to the higher time frame and then work your way down.